Let's get some business news for you now. Kate Moody is here.
Hello.
And Kate, tomorrow Iran is expected to announce that it will be restarting part of its nuclear program. It's the one-year anniversary since Donald Trump quit the deal. And that would effectively put an end to Europe's efforts to get around the US sanctions and continue trading with Iran.
Yeah, absolutely. Well, since the US withdrew from the nuclear deal and reimposed sanctions on Tehran, European economies have been trying to protect businesses there from the worst of the shock. To that end, they had been putting together a special trade vehicle with the goal of bypassing US sanctions and dollars, effectively allowing companies to do business by barter. France, Germany and the UK had hoped the system, called Instex, would encourage Iran to live up to its commitments under the nuclear deal. The US has long cast doubt on the viability of the system. A top official said on Tuesday it would be all but impossible to ensure that it's not used for money laundering or to finance terrorism. Take a listen.
It's going to be very complicated for the Europeans to really make this operation, particularly as they say they are committed to making sure it's operating under the highest AML CFT standards. I question how that's even remotely possible.
Beijing has confirmed that its top negotiators, led by the vice premier, are still headed to Washington, indicating they perhaps believe a last-minute trade deal can be reached before higher tariffs are set to kick in on Friday. But Donald Trump's latest threats have raised concerns about the knock-on effect, as Peter O'Brien reports.
The main threat to the world economy, more tension between the US and China. That's according to the International Monetary Fund, which described Donald Trump's latest threat of sanctions as unfavourable. His comments have heightened concerns about already slowing global growth.
The main French and European concern remains the risk of a world trade conflict and war driven by trade tensions between China and the United States.
President Trump said he'd raise tariffs on $200 billion of Chinese goods from 10% to 25% and impose increases on an additional $325 billion of imports. This brought into question the months-long truce in a trade war which has cost the world's two largest economies billions of dollars. But despite the threats, the Chinese government has said they're still sending a delegation headed up by Vice Premier Liu He to Washington for negotiations this week.
President Trump likes to make noise, he likes to make big statements, but my sense is that inside the Chinese delegation there's a realization that there's a lot of rhetoric, but there's not a lot of action.
US Treasury Secretary Steve Mnuchin said negotiations were almost complete, but blamed China for not sticking to its commitments. Trump warned that his higher levies would come into effect on Friday, the last day of talks, if no deal was made.
America's trade ties with India are also coming under strain as US officials call for fewer restrictions on foreign business there. In March, Donald Trump said he would end preferential treatment for over $5.5 billion worth of Indian goods. Delhi has in turn threatened higher import duties on American products. Speaking in the Indian capital, U.S. Commerce Secretary Wilbur Ross said the world's first and third largest economies should work together to level the playing field.
India is only the U.S. 13th largest export market due to overly restrictive market access barriers. Meanwhile, the U.S. is India's largest export market, accounting for something like 20% of the total. That's a real imbalance.
Well, Asian markets managed to recover slightly from Monday's steep falls, but the major European indices were still feeling the effects of those renewed tensions. Losses of about 1.6% across the board, the banking sector down 2.5% in Europe. Wall Street is even deeper in the red, the Dow Jones dropping as much as 600 points, its biggest drop since early January. It's been weighed down by heavyweights Caterpillar and Boeing. Their shares are down 3% and 4% respectively. The European Commission has once again scaled back its forecasts for economic growth. The single currency bloc is expected to grow just 1.2% in 2019. France is projected to grow just a bit faster at 1.3%. But the biggest surprise came from the Eurozone's biggest economy, rather. Germany's growth forecast was cut to just 0.5 percentage point. That's the second weakest pace in the bloc. Germany's economy is driven by manufacturing and exports and has been deeply impacted by the global trade tensions. Now, as you can see, Italy is at the bottom, the Commission forecasting just 0.1% GDP growth after it slipped into recession at the end of last year. European officials issued an even more dire warning about Rome's spending plans, setting the stage for a renewed clash. The coalition government is enacting a budget that includes higher public spending, which already raised tensions with Brussels last year. Now, the European Commission says the budget deficit is due to hit 2.5% of GDP this year and 3.5% next. That would breach EU rules, which mandate member states to keep their deficits within 3% of GDP. Rome could face sanctions if it doesn't bring its budget in line. The Turkish lira has dropped to its lowest level since October after the decision to rerun local elections in Istanbul. The currency has tumbled against the US dollar over the last year and dropped even further this Tuesday, trading at about 1.6 to the dollar. The March 31st vote showed a narrow victory for the opposition party, and the government's decision to challenge it is making investors concerned about the rule and respect of law and the future of economic reforms. Istanbul is the country's main commercial hub, accounting for a third of Turkish GDP. Well, this week, Ikea opened its first store in central Paris, part of a new strategy to reduce its reliance on big stores in the suburbs. The Swedish giant is not alone. Other chains have also been adapting to shifting customer demands. Haxi Myers-Belkin reports.
An explosion of blue and yellow confetti, and Ikea's central Paris store is open for business. It's a first for the company, more used to serving customers from mass suburban warehouses.
It's so simple. You can go to Ikea and come back on the metro.
It's 4 times smaller than the average Ikea, with half as many products on offer. But this was a savvy business decision.
We headed into the city center because we know that fewer and fewer people have cars, so we know that our business needs to adapt to this changing world.
This shop doesn't keep any large stock on site. You order in-store, with delivery coming in at a minimum of €60. For some, that defeats the point.
Delivery doubles the price, and the price is what's good about Ikea, so it's not a very appealing option.
City centres are quickly filling up with outlets of large brands that until recently were concentrated outside the city limits, in part because there's less red tape involved. They're also able to provide a better customer experience.
You don't necessarily find everything you need, but there is quite a good selection here. You can find what you're looking for very quickly.
This sports giant has now opened 6 city centre outlets. Their growth has reached double figures, while suburban Decathlon stores are reporting a decline in turnover. Rent may be significantly higher for shop space in town, but clearly it's worth it.
A trip to Ikea, is it still as challenging if it's in the city centre or not, Laura?
Well, I can't see people dragging home their wardrobes on the metro, but anyway.
Difficult.
Give it a go. All right, Kate, thank you very much indeed. Kate Moosey there with the business. We're going to take a short break. Don't go away. Much more still to come.